First session tonight is going to be all about the company PG&E. I'm going to sort of chat about that because it's a really different um, business that I've been talking about. And I know many of you that have been with me from day one, you've probably been thinking, this is a bit sort of out of left field for AB because this is a business that's basically been bankrupt. It hasn't got a great track record in the last 2 or 3 years, and it's just come out of bankruptcy, and Andrew's buying it. What is going on? So I want to talk about how it has ticked all the boxes for me, and the importance of understanding that occasionally when I see a business like PG&E, I'm not going to be able to help myself take a position in it, given the circumstances around the business. But the risk side of things for me is very, very low. So I'm not taking a major risk with this particular business. So we're going to finish that off tonight and talk about the company profile PG&E. Then we're going to talk about how to consider companies for your portfolio. I know many of you have experienced, some of you recently coming on board with us, others have had a portfolio for a while. You might like to make some adjustments in that portfolio, given the fact that we've seen a bit of a shift recently from um, some of the COVID popular businesses to the more long-term value businesses that we often talk about. So we'll talk about that tonight. I think that if I was starting out over again, there's a few businesses that I would want to make sure I had in my portfolio. I wouldn't know to do that if I was starting out over again, because when I first started, I was just like many of you. You're very green and you don't know a lot, so you're keen to be a sponge for information. And you can often have this feeling of overwhelm. You sort of have, I need to know more. I've got to know more. So you're reading this and you're reading that, and you follow this person, you follow that person, and your circle of influence gets really, really, really big, and it sort of doesn't help with your decision making. So tonight, I want to just have a general chat about companies for your portfolio. Should it be one? Should it be two? Should it be 10? Should it be 20? What's the difference between having a 15 strong portfolio or having just two businesses in your portfolio? What's the difference? Are there fors? Are there againsts? So we'll just generally have a chat about that tonight. And then in our third session tonight, I'm going to share with you a common mistake that a lot of new traders make that costs them money every single time. And unfortunately, I'm sort of seeing a little bit of a trend towards this recently here at Trading Mastery. And I think it does have a bit to do with the fact that the market's been pretty hot lately. Obviously, um, many of you have come into the program with the expectation of taking some positions in some great quality businesses and taking advantage of the situation that we're in right now, where there's a lot of good quality businesses that are still reasonably inexpensive and cheap, and you sort of want to get going quickly. So I'll cover something that's really important there. So what I'm going to do right now, I'm just going to put the Q&A away for a little bit, so I can't see any questions or comments, and we will get into the content. What I like to do also here, and what I think I will do going forward, just for the first 5-10 minutes or so, just sort of give you a quick wrap up on where I think things are at with markets right now. We're obviously heading towards Christmas. We've had an incredibly strong November. We can't forget that. The market in November on the Dow Jones and S&P and the Nasdaq rallied about 10 or 11%. I think it was the Dow Jones was up 11.8%. I think the S&P and Nasdaq were about 10.5, something like that. I mean, that's a huge rally in 1 month, a 10% rally. The Russell 2000 index, which is 2,000 small businesses in the United States in an index, it rallied 19% in the month of November. So to expect that we're going to see back-to-back months of 10%, 10%, 10%, it just doesn't happen, guys. It just does not happen. So the fact that we're getting closer to Christmas, the fact that in the month of November, the reason, the catalyst for the market rallying like it did was the fact that the presidential election came along, and what actually was the result was the market very quickly figured out that Joe Biden was going to be the next president. But the market very quickly figured out too that the Democrats were not going to get control of both the House of Representatives and the Senate, because if they did that, they would be able to push through Joe Biden's tax plan, which is basically to increase taxes on corporate taxes and some other taxes as well. And given the fact that the Republicans are still going to control the House of Representatives, um, the the Biden administration's going to find it much, much more difficult to put through the tax increases. So therefore, the market was cheering the fact that we're not going to have Donald Trump. I think many of them were cheering for that, and there was a vote of no confidence in the Trump administration. I know that 70 million Americans still voted for Trump, but there was about 75 or 76 that voted for Biden. Um, and the market wants stability. Donald Trump has not been a stable leader. The market is cheering the fact that Joe Biden's going to be a stable leader, and he's probably going to mend fences with China. He's not likely going to get the corporate taxes up quickly. So therefore, that's good news for financial markets. It's good news for company earnings. Okay. So therefore, the market was cheering that. Then on the back of that, we saw the vaccines from Pfizer and Moderna and AstraZeneca, those companies releasing statements saying, hey, we're going to have these vaccines available in the coming weeks. And in fact, just a couple of hours ago, one of our clients mentioned that I think it was Pfizer has now got approval in the UK, and the UK has been the first country to actually say, yep, we're going to start actually giving out the vaccines, administering the vaccines. So that's even better news. The market really rallied on the back of those two things. So what the market needs to rally again is it needs to get some new news. And the market is already priced in all of the good news. It's priced in the fact that Biden's going to be president, there's going to be stability and all that sort of thing. And it's priced in the fact that we're going to get vaccines for healthcare workers and the elderly later this month. So what the market is now waiting for is the big money will be waiting for, well, what's the next piece of big news? What's coming? Well, when you think about it, there's not a lot actually out there in the month of December that could come. You could look at the negative and say, well, the market could get spooked by all of these rampant COVID-19 cases in the United States and around the world. But the market's really ignored that for 6 months now because the treatments are so much better. There's a vaccine just around the corner. The death rates are not going through the roof. Certainly the virus contagion is going through the roof. So the market's ignored that. So the negative is really, um, it's tough to get negative about really anything at the moment because 2021's looking like it's going to be a great year. We're going to get a vaccine, we're going to get jobs back, we're going to get economic output improving. So even though it's not going to sort of skyrocket, it's going to slowly get better. But what's going to drive these markets? And there's always a catalyst. There's always a reason why. Now, I still think the market will finish December on a positive note. And I hope I'm wrong. I hope the market does rally 10%, but I just don't think it will. I think the market will maybe rally 3 or 4%, maybe 5% at best. Or even we could finish fairly flat. But then in January and February, I think the next catalyst could be earnings season. We're going to get fourth quarter earnings season for US companies in the first few weeks of January. And I think that they will likely beat estimates again. And then on the back of that, we're likely going to have in February and March a stimulus package, $2 trillion or more, that's going to be announced. And that is going to be potentially a catalyst as well. So I think there's a fair amount of good temperament, guys, that we're going to have through the month of December. It has been an extraordinary year. Those of us that were fortunate enough to get some money into the markets in the middle of the year or even April, May, we've got a little bit of a head start on some other clients, but that's okay. It's a marathon. It's not a sprint. So we're going to make sure that we keep that in mind, and we'll talk about that in our third session tonight. So before we get into our company profile, the following information is general advice only and has not been prepared taking your individual financial objectives into account. No listed company I speak about in this training tonight should be considered a recommendation to buy shares, as I'm not taking into account your personal circumstances. So that's important because I know a lot of folks, they see that I'm talking about a business or maybe even buying it for my portfolio. They immediately think, well, I should have it for mine. I want you to think a bit more deeper about it because there are sometimes like a PG&E that I'm going to talk about tonight. If I didn't have the runs on the board that I've got in 2020, I probably wouldn't be buying PG&E right now. Okay, so this is probably not a business that if I was starting out, I would be buying if I had the knowledge I have today. All right, so let's talk about Pacific Gas and Electric, a US based business that is listed on the New York Stock Exchange in the US. PG&E was founded in 1905. In fact, it actually merged with another utilities business. Now, when we talk about gas and electricity businesses, I'll occasionally reference them as utility businesses. That's what they're actually, the sector is actually called. Between 1905 and 1984, it grew to be the United States' largest electric utility business. So it was a very, very significant business by 1984. In fact, is still a very, very significant business today, as you'll see by the revenue, etc., compared to the other utility businesses across the US that I'll show you shortly. So PG&E is a US publicly traded company. It's on the New York Stock Exchange, and it's headquartered in San Francisco, in California. It provides natural gas and electricity to most of the northern two-thirds of California, okay, which is around 5.2 million households, or roughly about 16 million people. So it's a very, very significant business. In fact, to give you a little bit of an idea, the economy of California is bigger than Australia. Okay, so California is a very, very large economy. So we're really talking about a very significant utility business. Now, the PG&E share price peaked in 2017 at $71.57. However, between 2017 and 2019, leading into 2020, the share price fell by 90%, and it fell and traded to a low of $3.55 on the 27th of October 2019. So just over a year ago, it was trading at $3.59. It's trading about $12.69 now. So it's a long way away from the high of $71.57. And this is really where you've got to start to put the story together. Okay, why did the share price fall? What's the business all about? And let me walk you through that now. So the company received some significant negative press when it was found guilty. In fact, it actually pleaded guilty for triggering devastating wildfires in California. We have a family home in Thousand Oaks in California, which is just about an hour north of LA, and spend a few months there every year. In fact, we can't get there at the moment because we just can't get out of the country. But our son Jack is at college in Utah. He'll be over there for Christmas with Janine's mother. And you know, we've been there plenty of times in California, and for those of you that have been there, you'll sort of understand what I'm talking about. It's a very, very dry environment, and they have a lot of mudslides, and they have a lot of wildfires, and you know, when it's a very dry environment, it doesn't get a lot of rain, doesn't rain much in California. And what this led to was the loss of many lives, towns, homes, infrastructure. Basically what happened was PG&E from 1905 through to 2017 had built this incredible electricity grid and infrastructure throughout Northern California, which naturally has to go through forest and built up areas of forestry areas. And they just didn't keep trimming the weeds, you might say, trimming the trees. And fires started, towns were burnt down, hundreds of homes were lost, and 83 lives were lost in this actual scenario of you know, the very sad event that happened. So, of course, what happens as a result of that is a lot of lawsuits. And in January 2019, PG&E had to announce that it was filing for Chapter 11 bankruptcy. Now, this is a pretty big deal because Chapter 11 is actually a form of bankruptcy that you can enter if basically your liabilities outstrip your assets and you've got too many debts in the US. But it's actually a process where you can actually come out of bankruptcy. So that it works a little different in the US than what it does here. But essentially what happened was there were so many lawsuits against PG&E that it was responsible for what went on. And in the response to the financial challenges associated with the wildfires, that it was liable for all of this damage and monies and payments to people. It just couldn't continue in the way it was. So it had to actually file for bankruptcy. Now, what actually occurred was a lot of people thought that the California Utilities Commission, so there is an authority in California that actually looks after most of these utility businesses and sort of regulates them. They clearly weren't doing a very good job with PG&E, but a lot of people thought that the authorities would just basically wind up the business, get rid of the management. The infrastructure there was still there for the utility business throughout Northern California. They would clean that up and they would put a new management team in and they would start over again with a new company. But actually on June the 20th this year, a US bankruptcy judge gave approval for PG&E to exit bankruptcy, and that paved the way for the company to restructure and reestablish itself in Northern California and basically just keep going. So, with its lawyers and management and all those sorts of things, it came up with a plan that satisfied a judge in the court to say, well, hey, we think that you're a better option to go ahead and relaunch rather than folding and starting a new company. The infrastructure, don't forget, was already there. And there's a very, very significant difference between PG&E and a business like Apple or Microsoft or Trading Mastery or a business that you might be involved in right now. Now, you see here this slide here. So prior to bankruptcy, PG&E were a very, very profitable entity. In 2017, they were paying a dividend of 53 cents per quarter. So around about $2 annually for every share that you owned. And in fact, at the time, it was making about $1.6 billion. And you can see there, even in the financial year 2019, on the left-hand side, you can see I've got revenue, cost of goods, gross profit, net income. You can see I've then got PG&E, First Energy, American Electric Power, Southern Company, and Duke Energy. Those are the other four major utility providers in the United States. Now, what I want you to look at is look at the revenue, right, the gross revenue, and look at the cost of goods, right? It's a very, very profitable business. It's a very profitable business. But PG&E, the reason why it's lost so much money in the last couple of years had nothing to do with people not having electricity supply or the service. It just simply had to do with the debt that it had from the lawsuits. Now, as I'll explain in a few minutes, when it came out of bankruptcy, the proposal was as such that they were going to put some money aside to service the debt that it needed to pay back to the communities and rebuild the towns and help those people and compensate those people that had lost loved ones. So prior to the wildfires, as I said just a moment ago, PG&E posted a profit in 2017 of 1.6 billion. There was nothing wrong with the profitability of the business. In fact, the share price at that time, if you remember back to a couple of slides back, was $71. So the share price hasn't gone from 71 to $3.50 in 2 years because the service at PG&E was rubbish or the electricity was no good or the gas was no good. It just went to $3.50 because nobody wanted to own the business. They thought it was going to be wrapped up. And they had this huge lawsuit problem on their hands. Now, currently, PG&E has a market cap of 25.18 billion. So that's the number of shares outstanding on the market times the share price. Now, obviously, that market cap would have been a lot larger back in 2017, but it has assets and infrastructure of $85 billion. Now, this is really important to understand because if you're going to go out there tomorrow and start a coffee shop to compete with the guy down the road, then there's a reasonable chance if you've got good service and good coffee, you're probably going to survive. But there isn't anyone that's going to walk into California and start a utility business and have the money and the infrastructure and the approvals to build an electricity and gas grid like PG&E have built over the last 100 odd years. since 1905. Now, its current debt is listed in its financials at 79.8 billion. Now, that includes the compensation that it's agreed to pay. So PG&E has agreed to pay a significant amount of compensation over the years ahead to the people that it has done the wrong thing by. So you can see here, have a look at the share price up at $71. And you can see they're all the way trading down to $3.50 and closed overnight at about $12.70. So that's a major slide. And again, it's important to understand in many cases when businesses have major slides, something's happened in the industry, the product's no good, they've got a competitor come along. This share price decline had nothing to do with COVID-19. People are still probably using more electricity in the last 12 months than previously because they've been at home a lot more and all those sorts of things. So, the share price is where it is because of the debt the businesses had from the lawsuits. So in my view, and this is just my assumption from doing my research, and I don't think I'm alone when I make this conclusion. I think David Tepper and the BMIs that I mentioned earlier this week, BMI stands for Big Money Investors. I think they've come to the similar conclusion. Either that or they know something that I don't know, but I would suggest that a lot of what I'm about to share with you, that they would say, yes, we agree with that. So PG&E has been handed a golden opportunity because the California regulator, instead of taking the business back, has actually said, we'll give you one more chance. And that's a massive opportunity because they have a monopoly. PG&E has a monopoly, being the only electricity provider to over 11 million California residents. I mean, this is really significant. I mean, is anyone going to come along and start building a new power grid from scratch and compete with PG&E in my lifetime? No. Yeah, we're going to get some people put solar panels on their roofs and all those sort of things, but it's going to be insignificant, really, in the next 20 years. Do Northern California residents have another service provider that they can call and switch to? That's an important question. The answer is no. There are certain municipalities in California and around San Francisco where a few of the councils have actually got together and are buying electricity in bulk, and people are able to sign up to those services and get discounts. But at the end of the day, they're still getting it from PG&E. So PG&E, in my assessment, has a guaranteed revenue stream with no competition. Imagine having that. Imagine having a product that people can't live without, electricity. So it has no competition. It has a guaranteed revenue stream that is not going to go backwards. They have a restructured board of directors. They've restructured the entire board. That was part of the bankruptcy. And an interim chief executive, Bill Smith, and he's appointing a new CEO, which is actually just announced. And I apologize, I didn't put it in the slides, but I'll let you know in the report tomorrow. So all of these things that the judge has said, okay, so you've got a restructured board, and basically PG&E have said that give us one more shot. We'll make sure we look after the infrastructure. We'll make sure that we trim the weeds and trim the forestry and make sure that there are no wildfires that occurred back in 2017. That's all they've got to do. That's all they have to do to be an incredibly successful, profitable business, other than the general running of the business and making sure it does okay. But I'm sure that they can do that. They've done it for more than 100 years. So PG&E paid most of the money it owes under a $13 billion settlement into a trust fund. And that will compensate the tens of thousands of people who lost homes and businesses in wildfires. So it's important to note as well, though, that the 13.5 billion will be evenly split in cash and company stock, and PG&E will deposit the remaining cash into the fund in 2021 and 2022. And a trust administrator will issue the payments to victims and sell the stock over time. Now, here's the interesting thing, right? If the share price rises, given the fact that the money is going to be put into shares, it's going to be worth a lot more to the trust administrator, and potentially they're going to be able to pay down the debt quickly if the share price is higher. So it's in everyone's interest for the share price to go higher. Okay, and self-interest is a very big, significant thing in financial markets. Um, the thing to appreciate is if PG&E screws up, authorities will kill the business and take back control. But I don't think that's going to happen. I think they will put in a good board and a management, and I'm willing to back them on that. Now, I'm not going to put a lot of money, and I haven't put a lot of money into this investment. I might buy more. But for me, this is an opportunity where my investment is based on management not screwing up. It's not based on the infrastructure. It's not based on how much electricity people will use. It's not based on competition. It's not based on a lot of the traditional things that you would analyze a business for. It's just based on, is the management going to screw up? And you would think after everything that's happened, 100 people lost their lives, all they will get it right. So here's an interesting financial graph on the right-hand side. And what I want you to look at is I want you to look at the revenue remaining reasonably stable, up around sort of 16, 17 billion dollars. And you can see there back in 2016 and 2017, that was when they were making 1.6 and 1.6 billion dollars. And all of a sudden there's the big down years of the earnings. And that was because of the lawsuits. It wasn't because of the revenue. I mean, imagine, in most traditional businesses, if the earnings were that low in the negative, well, there would be no revenue. But the revenue was the same. So it tells you, well, it wasn't about the business delivering electricity. It was about them actually paying the lawsuits. So PG&E has a rough track record of not doing the right thing in the last 25, 30 years in keeping up with doing the right thing with this infrastructure and trimming the forests and all those sorts of things to ensure there are not wildfires. They certainly have not done the right thing. I think they're smart enough to realize that now. And given the significant disruption to the business and what we've seen in the last 2 years, I think they'll get it right. Revenue is assured with no risk of viable competition. Now, we won't probably see too many businesses here at Trading Mastery where I can say to you, hey guys, this business, the revenue is assured with little or no risk of viable competition. I mean, viable competition might be some, Tesla solar panels on the roof and those types of people, but it won't be really significant. It will likely return to paying dividends in the future. And if we were to go back and actually have a look, generally speaking in the US, utility businesses pay very handsome dividends. The dividend yield for PG&E was about 6%, which in the US is very, very, very good. And in the future, once they get out of this challenge of paying off the folks that they need to pay, they're going to return to paying dividends, just as banks in Australia will return to paying dividends next year and the year after. And that becomes more attractive to people because to get the dividend, you've got to own the shares. So therefore, when they do announce that PG&E, because they've got an assured revenue stream, and once they get the debt problem off their books with respect to compensation, they're going to be able to pay dividends, and therefore it's going to be more attractive for the average person to own. And that will push the price, I believe, higher. Now, I'm not blind to the risks with PG&E, right? It still has some challenges in front of it. And that's the reason why this is a very long runway for me with this business. But when I can take a bet on a company that has a monopoly and circumstances like PG&E now has, I'm going to take it every single time. So it doesn't meet the specific criteria that I often talk about in the Knowledge Center and talk about when it comes to buying Apple and those types of businesses, and recently, like Downer EDI that I talked about last week, and Bank of America, that kind of stuff. But this is a business that has a unique upside, but I'm not going to take it with an aggressive approach. It's going to be about 1% of my portfolio. But in any event, when you have an opportunity for a 5-bagger or a 6-bagger, meaning the potential for the share price to go up by 5 times, 6 times, with a margin of safety to the downside, meaning that the probability of the market pushing this back down to $3.50, in my view, is very low, then the runs on the board that I've got this year from the market, I'm willing to put money into this business. So the share price is below fair value because of the lawsuits, not because of the electricity or gas PG&E provide, or a diminishing demand for electricity. That's really a key thing to understand. And big money investors are buying because they recognize the potential and downside risk. And when I talked earlier this week, there was 6 big money invested, Howard Marks being one, David Tepper being another one. That is, it's 13.6% of David Tepper's $5.6 billion fund right now, PG&E, just announced in the last quarter. So that's the share price again right now, $12.60. And I would suggest most of those BMIs have been accumulating down around sort of $10 to $12, down around this level where we are now. It was actually a little bit higher, up closer to $18 back in June, but then it pulled back again. But back then, it rallied very quickly after the bankruptcy announcement. It pulled back when the market had a break in August. Now it started to move higher once again. So let's assume, I'm just going to give you a couple of let's assumes at the end. Okay, this is not a specific recommendation for you to jump out there and buy it. It may not be right for you. If you're a new client at Trading Mastery, you might look at something that as we talk about in our next session, something a little bit more solid that we generally go for here at Trading Mastery. But we're only probably going to get 1 or 2 of these come along a year. But let's assume you bought 500 shares at $12.69 current price. That'd cost you $6,345 US dollars. So more in Aussie dollars. You could change that to $50 if you 50 shares if you wanted to. I'm just using an example. And the share price takes 5 years to rally to $50. It takes 5 years to go from $12.69 to 50. Right? These are the sort of numbers that I run through my head and think about whenever I buy something. At $50, your investment is worth 25 grand. From 6,345 to 25 grand, and a rise of about 300%. So about a 3-bagger. That means on average you earn 60% per year on your money over that 5 years. Tell me where you're going to get a 60% return on investment in 5 years. And that doesn't include the dividends that you're probably going to get paid in the next couple of years if you own it. Now, it might go back to $50 in the next 12 months. I'm just saying if it takes 5 years, I don't care. I don't care because I don't think that there's probably a single business that I own right now that's going to give me 60% a year for the next 5 years. Let's say you bought 500 shares and it took 10 years to rally to $70. 10 years, 2030. Well, it's a 4.5 bagger, and you earn 45% a year on your money over 10 years. So again, it just goes to show, and that doesn't include any dividends or reinvestment. It's just the share price appreciation. So in my view, when you're looking at a business to invest some money into, don't look just at the very short term. I know many of you would like to enter companies and buy companies and get out of them in 12 months, 18 months, 2 years, and be able to pick up a handsome gain. And you will have those opportunities. I mean, there's plenty of our clients in this room tonight and not here tonight that watch the recording in the next few days that bought Tesla and are sitting on over probably 130, 40% return this year. I can generally predict what will happen over time, when it will happen, nobody can predict that. It's not possible for Warren Buffett or David Tepper or me or anyone to say this is when it's going to go up. That's just fanciful. But what will likely happen to a business like PG&E if it keeps its powder dry and it just does the right thing? What will likely happen is the share price will go higher because of all the things that I've been mentioning. So it pays to sit and do nothing in many businesses. And what happens if it takes 5 years and the price only goes to $20? What about in 5 years' time? It's gone from $12.69 to just $20, right? That's all. Well, I still make 11.4% a year, and that doesn't include the dividends either. And that would be better than leaving my money in the bank or giving it to a fund manager. So that's the kind of analysis that I've done with PG&E. And the way I look at it is that provided I don't aggressively enter this business, then the downside risk is reasonably low. It's not going to kill me if the price goes back down to $8 or $7. I'm willing to hold it. I'm willing to make sure they do the right thing. And the only reason why, in my view, the business wouldn't thrive and survive into the future is if the management do a pretty terrible job. And I'm pretty sure they won't. I reckon they'll do a very good job. And I think that David Tepper and the other investors, that the big money investors that have recently been buying PG&E, have actually concluded the same thing. Okay. Yeah, they have had, if you do a bit of research, Wayne's pointed out that they've had some other lawsuits over the years as well, with respect to a number of other things that have happened. I mean, when you're in a utility business from 1905 to 2020, there's going to be plenty of lawsuits over the years, absolutely. So that's an interesting observation, but you can do some research on that, guys. And if there's an ethical thing there and people don't feel that they want to invest in the business, then that's perfectly okay. That comes from time to time. Okay. If I had to choose a business that I was going to hold, it's a different scenario, Sally, for me with Apple versus PG&E, because Apple is a huge part of my portfolio. I mean, I trust the business like no tomorrow. But there are times where you get opportunities like PG&E. I mean, I can't compare the two businesses because they're very different. There's certainly no way I would invest the sort of money that I have in Apple in PG&E. And your question is, well, why don't I just buy more Apple? You could probably argue that point that why don't you just buy more Apple? But there could be some significant upside in the business in the next handful of years, and that's part of the game of trading and why I love it, and I want to participate in those businesses. So